China's third quarter GDP growth rate is at 6.9%. Although it beat market expectations, it's the first time it has fallen below 7% in over 6 years. And as Kim Min-ju reports, this could spell trouble for Korea, which is reliant on China for exports.
Indicating a slowing China, the world's second-largest economy saw its GDP growth rate fall to its slowest level since the global financial crisis. Beijing's GDP grew 6.9% in the July to September period from a year ago, slightly better than market expectations of 6.8%, but below 7% for the first time in over 6 years. This air of uncertainty raises doubts about China being able to reach its growth target of about 7% this year.
As for the reason why the growth slightly slowed in the third quarter, I think the main reason is that the international and domestic economic and financial situation showed new trends and new issues in the third quarter.
China's economy has been heading downhill since 2007, and other economic indicators are adding to concerns that Beijing's slowdown may be worse than first thought. Industrial output rose 5.7% in September from a year earlier, below forecasts of 6% growth. Fixed asset investments, another major driver of the economy, also fell below market estimates of 10.8%. This is despite China's efforts to lift its ailing economy by cutting interest rates and devaluating its currency. It raises concerns for Korea, with more than a quarter of its outbound shipments heading to Beijing.
China's slowing economic growth rate will have a negative impact on Korea. Korea has already seen its exports to Beijing fall, and as China turns to focus on expanding its domestic supply of intermediary goods, Korea's trade to China can only head downhill.
Experts say while Beijing may take further stimulus measures to prop up growth, Korea will need to diversify its exporting countries in order to reduce dependence on China, as well as focus more on exporting finished goods or consumer goods. Kim Min-ji, Arirang News.